Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is 10:30 UAE time, September 12th, and we have Brent crude oil making a little bit of a comeback. I don't know if that's egg in the pudding a little bit, but nonetheless, it's since OPEC Plus made that choice about a week or so ago to abandon its plans to raise supply in the fourth quarter this year. There's been a somewhat of a consolidation, at least that's what it feels like. The reasons why may not be due to that, but ultimately, what has been a steep decline over recent weeks and certainly over months seems to have at least paused. $70 Brent doesn't seem to be a floor that this market wants to break through for very long. It tested it. Uh, where do we go from here? Let's kick off and welcome back to the table Maliha Bengali, founder of MB Commodity Corner. Maliha, your thoughts a week, I mean, in the day after the latest sort of inflation numbers out of the United States, this market looking for direction maybe?
You're absolutely right. So the focus right now is what is the Fed going to do and how much are they going to cut? The market's pretty much bagged a 25 basis point cut, but obviously they're very eager about a 50 basis point cut. The data yesterday was really interesting. The CPI came in showing a core 0.1% higher than expected, which actually means the Fed really shouldn't be cutting 50 basis points. So the market reacted negatively, but then obviously NVIDIA came out inside saying some words. So the market really is quite technical. Our logic has been very simple, right? The Fed needs to cut at some point, but they can't go too soon, too fast because there's issues in the foreign currency markets against the yen. They don't want to spike inflation back up again, but clearly the economy needs some sort of a reprieve. So the question really is the data, on the one hand, they say the economy is robust, but then on the other hand, they say they need to cut inflation, the rates. So there's a bit of a dichotomy in the markets because the bond markets and commodity markets are signaling that the Fed needs to cut really soon, but the equity markets cannot take the view that they're rallying on back of a cut, but also the data is good enough. So there's a lot of like miscommunication in the market, we think, and it remains to be seen. But I think doing anything more than 25 right now will send the wrong message.
Well, we might say that they have clarity whenever everybody else doesn't seem to have clarity. 50 basis points would be a big sense of we know exactly what's happening. Jay Maru, head of market intelligence and analytics, MENA for Vortexa. Jay, your thoughts on the direction of travel? We're now towards the end of the big APEC gathering of the oil markets industry in Singapore. Do we have a sense of direction? If you're OPEC plus, what are you thinking?
Yeah, I think if I'm OPEC plus, it depends which part of OPEC plus I am, and as according to what I'm thinking. And I
Well,
think,
hopefully you're the biggest one with the most oil and the most
yeah,
revenue. And
exactly. So on that front, I think it's a very different proposition compared to the other members. And so what we were seeing actually in our data is the difference between what Saudi Arabia has been doing with its exports and what the other members, such as Iraq, Russia, Kazakhstan, other members have been doing. Actually, if you look at what's happened with Saudi exports in a historical context, they are much, much lower than the norm, the average over the past few years. They've really been keeping a lid on their exports and productions at the cost of what the other members have been doing. We know we've had updated plans, revisions to compensation plans for the likes of Iraq, for the likes of Russia and Kazakhstan. And up until now, not really much has changed at all on their exports and their production data doesn't look like much has changed either. So in terms of direction of travel, Sean, ultimately there has to be a point where the frustration kicks in and a change in course is given. When that happens is the $1 billion question, so to speak. But it's been happening for a long time, where there's this divergence between what Saudi Arabia is doing and what some of the other large producers have been doing. Having the decision delayed up until December buys a little bit more time to kind of apply more pressure behind the scenes and to kind of see if there's any signs of increased compliance or decrease in exports as a result of that. But then come December, I think, yeah, we really are getting to crunch time as to whether we see a stronger decision by all members of the group, or maybe we see a slightly different course of action.
Osama Rizvi, energy and economic analyst at Primary Vision Network in Pakistan. Osama, they're like in OPEC plus, Jay just saying there, which part of OPEC plus, like in Asia, the consuming universe of Asia, from the ginormous China to the not so small Pakistan. Where is there a uniform narrative in sort of Asian economic well-being as we come out of the summer? We clearly have a negative bearish sentiment on China. Does that same sentiment carry across Asia?
Well, Sean, if you look at the region, there has been some sort of a glimmer of hope recently. Even the recent economic data from China shows an uptick in exports. And I mean, imports didn't increase as much, but still it didn't fall as well. If you look at South Korea, they also registered an increase in exports. Japan is now very keenly following everything across the world. And I think we should be following Bank of Japan's moves more than what the Fed is doing, because the Fed's moves are now one way or the other anticipated and discounted for. But the Bank of Japan's interest rate can become one of the triggers of what might cause a very significant correction across the world. Coming to Pakistan and India, we have seen that Indian imports of Russian oil have fallen a little bit, but still remain strong. Pakistan, like any other import-based economy, they're happy that the oil prices have fallen. We have also seen that being translated at a lower petrol price at the pump. But overall, I believe, to add to the question of OPEC Plus, I believe, and I said this on the podcast as well, the issue of the production cuts and how prolonged these can go is becoming serious now. Saudi Arabia has registered, as you know, there was a deficit last year as well. There is an estimated deficit of $21.1 billion this year as well. According to the IMF, the break-even price of oil for Saudi Arabia, the fiscal break-even, has gone up 19%. From 80 back in May 2023 to 90 in April 2024, which is 32% higher than the current price of Brent. So I mean, we should be looking at this point as well. I don't think this will sustain for long. And another oil price war might be in making.
Maliha, just welcome your thoughts on China, and particularly the issue of deflation. We had a recent story in Bloomberg saying that the headline of the story, which certainly grabs one's attention, China's deflationary spiral is now entering a dangerous new stage. We've all been sort of speculating, trying to read the tea leaves on the Chinese economic well-being since it's come out of COVID or lifted the COVID restrictions, and always anticipating that they were just, the next quarter going to get there and get out and move on, move forward. This deflationary scare, this deflationary reality would seem to indicate that this is a much more longer-term malaise for the Chinese economy.
Sean, our view on China has been consistently the same for the last year as we're speaking on the podcast, right? We are very bearish on China. We have been very bearish. All our demand indicators had always been pointing downwards. China is going through a massive deleveraging process that started post-COVID in 2022. They've been looking to inject liquidity, but that liquidity rally fizzles out in a couple of months, right? What the market on the Western economists expect China to come up with this bazooka stimulus, as it always does, and save the world economy. But China has been reiterating that they're not going to do that. They're a new economy. They focus on the domestic consumer. They have a lot of debt. They have the property bubble right now. So Xi Jinping has been very straightforward as to what their focus is. So as we wait, China is going through a deleveraging process. Demand it's just too weak, right? So the question is,
I mean, is it a Japan pathway now? I mean, we saw Japan stagnate for 2 decades, not 2 quarters.
It's definitely possible, and something that's not been priced in by the market. So the commodity markets have been on a one-way downtrend. So you have everyone talking on the Western side saying we're going to see a massive recovery, but China has just been going lower and lower and lower. So as opposed to the US being received, saved by China, China might take all the markets down because there's a global synchronized slowdown. Forget the US market, right? So yes, the demand is weak. Look at copper price. Look at the oil price. The Chinese don't need to buy oil demand. So OPEC's numbers of oil demand are completely ridiculous because China has been actually demanding less by 300,000 barrels per day this year, versus they expect plus 700,000 barrels per day this year. So we need to reassess what's happening. But there's a massive issue that will not be solved overnight by some $1 trillion stimulus. If they do, their currency's in turmoil, even with the yen. So both these countries, Japan and China, cannot go and print more money because their currencies will be completely going out the door. So there's this dilemma. But yes, in a secular decline, we see this massive deflationary. That's why the Fed has been so lucky, because that disinflationary cycle has helped the US with this immaculate disinflation they talk about. But we think it's a lot worse than it is. We're not worried about inflation. We worry about this being a recession. So that's our view.
Jay, looking at that, I mean, there is this sort of, the picture and that is being painted there, and then there is the reporting that China's still importing, as reported by Reuters today, in August, the equivalent of 11.5 million barrels a day. I mean, that's a chunky all is well in Beijing number. How do you interpret that versus the sort of wider backdrop of the bearish sentiment of China?
Yeah. I think it's really interesting. There is this continuous picture of, or this concern about Chinese demand, and that still exists. And that exists whether China imports 10 million or 11 million barrels a day. The issue here isn't of how strong China's demand is. I think that's pretty clear. That's been lower than expectation for much of this year, and it's probably going to remain the same for the rest of the year. The question is, at what price does oil become attractive enough for opportunistic buying from China? And actually, I think we are getting, the lower the price goes, the more attractive it gets for China. And it gets especially attractive for China because China has access, or does have access, to the cheapest oil in the market, namely Iranian and to some extent Russian crude as well. So the lower the oil price goes, the weaker the dollar gets. This is effectively a short-term quick win for speculative or opportunistic buying from the Chinese perspective. And this is very different from buying which is driven by industrial growth or macroeconomic growth. We really need to separate the two because that can create a very skewed picture. And I agree, we did see higher imports in August from China, but to some extent that was also driven by weaker than expected Saudi OSPs, and also that trickled through into more Iranian buying as well. So yeah, it's definitely opportunistic rather than any kind of real green shoots of recovery when it comes to China.
I mean, Osama, OPEC Plus looking at these different sort of yardsticks in which to make policy decisions around. Obviously, they made the decision last week to postpone the rise in supply, the return of supply from October through to instead to start at the end of the year. Your thoughts on that decision? I mean, in a way, the lower the price is, the more attractive it is, and it may also serve the purpose for OPEC Plus to squeeze higher cost producers out of the market. So maybe as a strategy, whether it's by design or default, it could be a benefit for OPEC Plus.
Well, Sean, what has been happening up to now is that the opposite seems to be true. If you look at the non-OPEC production, Guyana, Brazil, even the US, one of the biggest oil stories and most relevant as well, we are seeing, if not falling production, but the production is stagnant if it is not rising, right? So much so the rig count and primary region's frac spread count both have fallen this year versus last year, but the oil production in the US still remains the same. There was an increase of about 0.4 million barrels this month, if I remember correctly, as John Kemp reported in his latest newsletter. And that was a little bit low, but there was still an increase. The horizontal drilling technology, the frackers, they are still resilient. Diamondback and other, I've forgotten the name of it. They reported that they can drill oil as low as 45 barrels, per barrel. So that is something that OPEC Plus is really considering. And I think this strategy, which, as you mentioned, has gone awry at the moment. Technological advancements and fiscal discipline by the other oil producers have really made them more resilient. That is why I still believe this will be an interesting dynamic to watch as we move forward, because I personally remain very bearish for the global economy. And as long as the demand does not surge or picks up back again, this dynamic is going to cause wild swings in the oil prices.
We've seen in recent years, Malia, over the last 10 years, two sort of notable moments in which OPEC Plus have sort of chosen the pathway of price war, if you like, squeezing what are the sort of free riders of the higher cost producers in other parts of the world, the IOCs in many places, in Texas and elsewhere. Is this a moment as we go to the end of the year for OPEC Plus to consider another moment? Because they've delivered such a gift to the higher cost producers over the last few years that clearly carrying 6 million barrels of cuts, that party should be over. Your thoughts on that as a strategy for OPEC Plus to consider as they go into 25, open the taps as they plan to and squeeze out the higher cost?
You're absolutely right, Sean. They should have done this exactly about 2 years ago. We've been saying this, right? Because the more they fund this sort of deficit, so to speak, they're helping the non-OPEC supply growth. Now, having said that, it would be a really shameful thing to do right now because they've lost face and credibility. Honestly, they could do that and get rid of, $40, $45 oil is probably fair value. It should not be trading anywhere close to 70, 80 right now with the demand we have. But I think they have a link of hope. Like I said, right now, the market is pretty much in the soft landing, no landing scenario. And that's what OPEC is taking the cue of. If things get quite worse in the economic markets right now, the financial markets, they may have to do that because longer term, we know they need 90 plus oil. So the question is, are they going to fall back right now? There's a sort of a chicken and an egg game, right? The Fed, the US economists, OPEC, they're waiting to see how this sort of develops into after the election. And then there may be something because election uncertainty is also a big sort of parameter. But you are right. That could be one strategy. We think it'll probably be a bit too late. But the short-term gain over long-term, short-term pain over long-term gain is definitely the right thing for them to have done, for them to be more, better. But I don't think they do that right now. I don't think so.
Well, they certainly didn't do it last week and chose to keep the cuts in place. But as they, we asked the question yesterday in our survey as to whether, OPEC Plus had any sort of cards left to play in terms of the strategy of the last few years, which was essentially, cut to elevate the price and balance the market. 75% said, does OPEC have any more cards? No was the resounding answer. But Jay, maybe this is the card, the lower price trajectory, squeeze out all of these higher cost producers, if at least put them in a bit of pain, take some budget away from expanding future production capacity. Your thoughts?
Yeah, so I think it's interesting. The question is, does OPEC Plus have any cards to play? I think OPEC Plus as a group, the cards are shrinking. But actually, if you look at Saudi Arabia, UAE, maybe one or two other producer nations, they still have cards to play in terms of spare capacity available. And also, more importantly, the ability to quickly get oil into the market. Now, if you look at other producers, namely those in West Africa, they've struggled with production hitting quotas for a long time. So even if OPEC Plus as a group was to kind of open the floodgates, so to speak, these guys would really struggle in actually maximizing that opportunity there. What it would obviously support is the likes of Saudi Arabia and others, and a select few to really lift exports very quickly. Whether that happens is very difficult. I think the longer prices go down, the longer non-OPEC Plus grabs more and more market share, and the more demand prospects seem weaker for a prolonged period of time. I think that will push a change in course at some point. But up until now, I think we've seen this kind of wait and see approach for quite some time, and I think maybe there's still a little bit more legs left in it, or rightly or wrongly.
Osama, I see you shaking your heads there. I can't see how the UAE, because we sit in the UAE, who have fought so hard for so long, A, to spend so much money in raising their production capacity, and B, lobbied so hard, OPEC Plus, to raise their quota, finally getting that this year, which kicks into place in January, that they will not proceed with that. Your thoughts of that new sort of strategy I'm proposing?
Well, I believe, given the dynamics that Malia and Jay had just mentioned, I believe there is also a chance, a possibility that each of the members, like UAE and others, they might go in their own way. I mean, some might call it cheating, some might call it cracks appearing in the OPEC Plus membership, but economic imperative, and we have seen this happening, especially after post-COVID-19, post-Russia-Ukrainian war as well, and in the face of the recent geopolitical conflicts as well, that countries tend to become, or the world has become a little bit more selfish. The national interest has triumphed over the collective or ideological things, and this has been observed everywhere, and I believe this holds true for the oil markets as well and all the players in it. So if things do not improve, UAE, or for that matter Iraq, or for that matter Saudi Arab, the de facto leader, might go their own way. That once again leads to the either two of the possibilities: an oil price war by producing more, or everyone going their own way, and cracks beginning to appear in the OPEC Plus cartel. But
Well, there are
I don't know
many.
what will happen. I think much of it will depend.
Sorry, let's go to the survey question, and which is obviously on this subject. OPEC Plus to launch what would be its third oil price war in a decade to squeeze out higher cost producers by simply proceeding with the output increases they've already announced. I'm not talking about the idea that you're maybe the motivation, the incentive for moving ahead with the output increases is different in this thesis, but these have already been planned, right? These are not new idea, but go ahead with them because they probably will result in a lower price trajectory, but they will squeeze out the freeloaders you've been carrying for 4 years. I mean, look at the profits of the IOCs over the last few years. They've been absolutely ginormous, been off the charts on scales they're even in their craziest dreams they could have never have imagined.
I also...
So agree or disagree on this thesis that in moving in, they will move ahead with their OPEC Plus to launch what would end up with, I suppose, in a squeezing on the price side. Malia, looking forward onto the idea of what in the immediate term, what gives this market direction? I've always sort of felt that with this recent turbulence we've seen, yes, we're sort of pointing to China and the uncertainty of China, but it's really all about the Fed. Once we get the other side of the Fed trigger pull, that the fog will clear and we'll have a sense of direction of travel, and all will normalize around that. Your thoughts on how important an event that is next week for all markets, all financial markets?
Sean, I'd like to just give an anecdote to everybody on the podcast right now. You know, in 2007, we had a very similar situation. The markets fell 10%, rallied back 11%, and then crashed after the first Fed cut. Everybody expects the first Fed cut to save the market. The question is, it's not the cut itself, it's the timing of the cut. Is the Fed cutting right now into an economy that's solid, or are they cutting into an economy that's already falling apart? If it's a latter, then the markets can fall and everything can fall a lot more. So this is the big dilemma right now. And we know what happened in 2007. Every Fed official kept saying there's nothing to worry about. There's no recession. We saw Lehman collapse a month later. So I'm quite agnostic, as to what the Fed can or cannot do, but it's more about how are we right now? Will 50 basis points save the economy? Will we see growth right now? The US economy has $36 trillion in national debt right now. Even the fiscal spend's rolling over. The economy is rolling over right now.
Why is that an issue now, though? I mean, clearly that's not new. You go to Times Square, you can literally see the number ticking over every second. I think they've even taken the board down, have they? Because the number's too big.
But the question, Sean, is they can't happen right now. There's an election right now. So until anything happening will be Q1 next year if there's another fiscal spend. Can the economy withstand 3 more months of negative? It's breaking apart. Talk to any consumer or retailer out there. So the question is, we're in a very sort of narrow window where we have no liquidity. The Fed can only cut 25, 50 basis points. What can possibly save the market? Back in 2020, we had the Inflation Reduction Act. We had the COVID stimulus boost. So what can we possibly see this side of the year to help the markets? And if China is really falling out of bed right now, could we actually see a massive collapse? The liquidity is what drives the markets. And right now we can't see anything coming to the market, and we don't see the consumer. 40% of GDP of US is US consumer. How are they going to pay right now when they can't afford their bills right now? So where's this demand growth that we talk about that's going to happen? We don't see that happening. So like I said, it's a very narrow window. If we come and see a bazooka stimulus in China and the Fed, forget the dollar, just buy anything crypto or commodity related, right? The debt's going to go through the roof. But are we going to see this before November? I don't think so.
Jay, your thoughts on this, picking up on that? I mean, we saw the big debate yesterday between Kamala Harris and Donald Trump. We're sort of in the sort of red lights flashing phase of the election. And we were just saying there that, we're no direction of travel until the Fed decides what it's going to do. And maybe in a wider picture, no real direction of travel until the US presidential election. And hence maybe why OPEC Plus chose 2 months, not 1 month, not 3 months, but to move their next decision to after the election. Your thoughts on what these big moments, which are going to give or which will give the direction of travel to this oil market, which seems to be kind of consolidating now in this moment, at least for these few days, has stopped falling into the 60s.
Thanks, Sean. Yeah, I think so. I'm going to be a little bit boring here, but I'll reason why. I really don't think it makes that much difference on US oil prices, on US oil production, whichever party wins the US election. What it does make a difference on will be the way Russian oil exports versus Iran exports are treated. And so maybe, let's say, potentially if Trump does come in, I'm not saying I'm a political forecaster by any means, but if Trump does come in, maybe that could lead to a change in the way US oil is sanctioned, or the level of enforcement which is applied to sanctions on shipping companies. Maybe that is relaxed, but at the same time, we've all heard how Trump's stance is towards Iran, especially. So maybe there's a kind of a seesaw effect there. Net for net, I still think even if that does happen, it doesn't really affect global supplies too much. It's just a pivot with one supply source being more available to the rest of the world than the other.
Sam, I wanted to get your thoughts on a story that we're carrying today in our news digest from the Saudi newspaper, Arab News, that Aramco will start opening Aramco-branded gas stations in Pakistan before the end of the year, after their acquisition of a 40% stake earlier this year in Gas and Oil Pakistan. What does that tell you about the relationship between Pakistan and Saudi Arabia? It seemed that it hadn't been in a great place in recent years. Is this some signal that it's repaired? Where does this outlook guidance from that?
Well, Sean, Pakistan is currently seeking an IMF bailout, which has been delayed by, at a very critical time. And one of the conditions of the bailout is to get a rollover of $12 billion of debt from certain countries. And Saudi Arabia is one of them. China is one of them. And I believe personally that there has been some backdoor deals or something like that, as you mentioned, some tit for tat. So we give you that and you give us this. And I believe the economic imperative here is forcing the country and the foreign policy to get back at these countries in a positive manner and reclaim and reconcile the relationship that was recently faced a little bit of hiccup.
But we've seen that same strategy in recent years with Egypt, where instead of sort of loans or straight sort of cash injections into the central bank, there is acquisitions of assets and investment in real estate development and so forth, as Egypt itself was in the midst of an IMF bailout. Is that a similar framework as you're assessing? It's in nobody's interest in this general neighborhood to see Pakistan in any way economically implode.
Yes, I mean, there have been lots of parallels made with Egypt, so time is very short. I won't go into the detail of that, but I believe the scenario is different in the case of Pakistan, and hopefully we won't go down that trajectory. And if we get the IMF bailout, things will start to improve by the first quarter of next year, certainly.
Well, we'll have to leave it there. Wrapping up, we're looking at the survey result, 50-50, agree, disagree on this question. I always love 50-50s. It means you're sort of getting to some point of interest as compared to 90-10. So we'll drill further into that theme and see where it goes in other conversations. But until then, I have to say thank you very much to our speakers. As always, wonderful to have you guys back at the table. Jay Maroo of Vortexa, Maliha Bengali at MB Commodity Corner, and Osama Rizvi at Primary Vision Network. Thank you guys very much. It's always great to go around the world in 30 minutes. Thank you. Bye-bye.
Thank you. Thank you. Bye.